Welcome to FinFacts Live. My name is Evan Kinne. I'm joined today by Andreea Matson. Andreea is in our New York office for George Smith Partners. Andreea wrote a very interesting article this week about sort of the private financing and the real estate-like financing of FBOs. If you're not familiar with an FBO, Andreea, what is an FBO?
So basically an FBO is a fixed base operator. And the way it works is in the United States, airports are publicly owned and they are typically master lease to a local authority. Like JFK is owned by the city of New York. It's leased to the Port Authority of New York and New Jersey. And a fixed base operator will come to an airport like JFK that is already up and running and say, we want part of your airport where we will store our private aircraft. Maybe it will be a private terminal for private air travel. And that deal is financed entirely by the owner and operator of that particular FBO. So this is very popular in very large airports like JFK. There's a high demand. Private air travel is actually one of the fastest growing segments of the luxury economy. So we've seen massive growth in the FBO and hangar space specifically.
So, most people assume that airports are government funded. What is actually changing?
So this is true and continues to be true. Since airports are publicly owned, the path of least resistance for financing is tax-exempt bonds. So essentially, an airport will pledge or reveal their revenue streams, which can come from a variety of different ways. That revenue is then tied to how they secure financing in the bond market. Now, the issue that we're seeing is that two issues here. Demand for the private segment is outpacing the ability to finance it through this mechanism. And there's just a lot of the government-funded bonds and grants have been depleted or are frozen. So, for example, every time you buy a ticket, there's a very small charge on each cost that goes towards the maintenance of airports and goes towards funding terminals and, airport affiliated updates. This has been frozen since about 2000. This fee has not gone up. So they're just increasingly limited ways for airports to get money. So this leads us to the private market space. In Europe, a lot of the airports are actually privately owned. So it's much easier for airports in Europe to get financing, which goes towards critical updates, security features, transportation to and from city hubs. All of this goes into looking at airport funding. Here in the United States, it's a little more tricky and a little more challenging because of the way that the ownership of airports are structured.
So why would a real estate investor care about airplane hangars?
Well, ultimately, it's not about the airport and it's not about aircraft. It's really just understanding how this is a true real estate deal. We're looking at massive supply constraints. This is ultimately, it's industrial infill with a ground lease structure. So when you're looking at something that is so supply constrained, something that requires massive capitalization, there's in the article I wrote that there is a probably close to almost $200 billion delta of financing that needs to occur to just keep up with baseline airport infrastructure in the United States over the next 10 years or so. So the public markets cannot meet this demand. This is a true real estate opportunity. And if you have people who understand the storytelling around an airport hangar or an FBO, there's a lot of activity in the private space. A lot of the big private equity groups are coming in and seeing this opportunity. So the opportunity and the demand is there.
So there's been a few recent large deals, right? So institutional capital is in the space. And I think this year there's been a couple of large deals, correct?
That's correct. So Bain has come into this market. KKR and Apollo have come into the market. We're talking billions and billions of dollars worth of transactions. There are a number of operators who have become very well known in the space. So Jet Aviation is one of them. Blade is another one. So ultimately, what we would look at from the capital markets perspective is who is the operator, what does the ground lease structure look like, and who is going to be the end user. Of course, location matters very much as well. I mean, the three most important things in real estate: location, 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 right?
So if a developer came to you tomorrow, what would you tell them about raising capital?
Well, two things. One, which I already alluded to, is this requires a nuanced ability to convey a story. I think if you go to any lender who does multifamily or industrial, they're not going to understand the nuance behind the ground lease structure and the importance of the end user and, creditworthy tenants. So maybe if you're a sponsor or developer, you go to one or two capital partners and they don't understand the story. So you think that there's no capital there. But there is plenty of capital out there. You just need to work with someone who understands what capital is looking for and how to communicate this effectively. And then two, I think, you really have to understand ground leases very, very well. You have to be able to communicate the strength of a good, solid deal with a 40-year ground lease versus a stellar deal on a 15-year ground lease. There are pros and cons to each of those. So I think truly understanding the end user, identifying a credit tenant, and the ground lease structure, that are the two or three main things that I would make sure that the developer understands.
Great. Well, thank you again. And just for all of our listeners, don't forget to read the article. You can find it at gspartners.com. Sign up for FINFacts, and you can see this article under the Insights tab on the GSP website. All right. Thank you.
Thank you.